Every financial privacy protection you have ever had is about to become optional. And the people making that decision are not asking for your opinion. The United States Federal Reserve's Central Bank Digital Currency Initiative, described officially as a research project, framed publicly as a potential payment system modernization, and discussed by its architects in terms of financial inclusion and payment efficiency, is not primarily a technology project. It is the most significant restructuring of the relationship between American citizens and their money since Franklin Roosevelt's executive order mandating gold deposit in 1933. The stakes are not technical, the stakes are fundamental, and the 2027 timeline that is appearing in Federal Reserve technical roadmaps, Treasury Department infrastructure planning documents, and the Bank for International Settlements coordination frameworks is not arbitrary. It aligns with a global digital currency competition that America is currently losing to China, and that the architecture of the digital dollar will determine in ways that affect every bank account, every retail transaction, and every financial privacy assumption that Americans currently take for granted. By the time you understand the mechanism, you will understand why cash matters in ways that most Americans have never been required to consider. Chapter 1. What the digital dollar actually is not what you have been told. What the architecture reveals: a central bank digital currency is not a digital form of cash. This distinction is not semantic. It is the entire substance of the debate. Physical cash, paper currency, and metal coins is a bearer instrument. The Federal Reserve issues it, but once issued, it carries no information about its holder, its transaction history, or its use. Cash is anonymous by design. The privacy of cash transactions is not a technical limitation of the payment system. It is a deliberate design feature that reflects a specific conception of the relationship between citizens and monetary authority. A central bank digital currency issued by the Federal Reserve in the architecture described in the Fed's Project Hamilton technical reports, in the Atlantic Council's CBDC tracker analysis, and in the Bank for International Settlements CBDC design principles is programmable. Every unit of a digital dollar will have an identifier. Every transaction will generate a record. The question that its architects have not resolved publicly is who controls access to those records, under what legal framework, and with what limitations. The difference between those options is the difference between a payment system that preserves the financial privacy of citizens and a payment system that provides the monetary authority and potentially its law enforcement and intelligence partners with complete visibility into every financial transaction conducted by every American. The Federal Reserve's official position is that the digital dollar would preserve privacy protections equivalent to or exceeding those provided by commercial bank accounts. Commercial bank accounts are subject to Bank Secrecy Act reporting requirements, anti-money laundering monitoring, IRS reporting on interest income, and subpoena access by law enforcement. The standard being proposed as privacy protection for the digital dollar is the commercial banking standard, not the cash standard. If you believe that commercial banking privacy is adequate, the digital dollar presents no additional concern. If you believe that financial privacy is a meaningful civil liberty that the commercial banking framework already substantially erodes, the digital dollar represents a further and potentially decisive erosion. Chapter 2. The China race that is driving the timeline. Here is why 2027 is the date that appears in every serious policy analysis of the digital dollar. China's digital yuan, the ECNY, is not a research project. It is a deployed payment system with 261 million individual wallets as of the end of 2024, operational in 26 Chinese cities, integrated with WeChat Pay and Alipay, and used for 8 trillion yuan, approximately $250 billion, in cumulative transactions since its 2020 pilot launch. The People's Bank of China did not build the digital yuan primarily to modernize domestic payments. It built the digital yuan as the payment infrastructure for a China-centered international financial architecture that operates outside the dollar system. The mechanism is visible in the mBridge project, a cross-border payment system developed jointly by the central banks of China, Hong Kong, Thailand, and the United Arab Emirates that enables direct exchange of digital currencies between participating nations without requiring dollar intermediation through the SWIFT network. As of 2024, the Bank for International Settlements Innovation Hub had facilitated 22 participating countries exploring connection to mBridge infrastructure. None of them are NATO allies. Most are major commodity exporters, the precise economies whose dollar-denominated commodity transactions anchor petrodollar recycling. The 20,000 Sapphires timeline for American digital dollar infrastructure matters because China's cross-border digital currency infrastructure will reach operational maturity at approximately that point, transitioning from pilot to production scale in ways that allow willing nations to conduct commodity trade, capital flows, and bilateral settlements entirely outside the dollar correspondent banking system. If the United States does not have competitive digital currency infrastructure by 2027, the window for American influence over the architecture of digital currency systems closes in ways that are technically reversible, but practically very difficult to reverse. This is the geopolitical argument for the digital dollar's urgency that Federal Reserve officials make in congressional testimony and in technical papers, but rarely in public communication accessible to general audiences. The digital dollar is not optional from the perspective of dollar hegemony maintenance. The choice is not whether to build CBDC infrastructure. The choice is whether to build it in a form that preserves citizen financial privacy or in a form that follows the technical architecture that surveillance-optimized financial systems are designed to support. Chapter 3. What happens to your cash? Now address the question that is the title of this analysis directly. Cash is not being abolished by the digital dollar's introduction. No serious policy analysis proposes eliminating physical currency in a single legislative or administrative act. The displacement of cash occurs through the cumulative effect of infrastructure changes that make cash progressively less convenient. Merchant acceptance declines as digital payment processing costs decrease. Banking infrastructure that handles cash becomes more expensive to maintain as transaction volumes shift to digital systems, and the network effects of universal digital acceptance create social and commercial pressure to use digital systems that cash cannot compete with. The Congressional Budget Office's 2023 analysis of CBDC implementation scenarios included a projection under which physical currency circulation declines by 60% within 12 years of full CBDC deployment. Not elimination, a 60% decline in the circulating stock of anonymous payment instruments in 12 years. For the 5% of American households that the FDIC identifies as unbanked. 9 million households. This trajectory represents a direct threat to financial participation. For the broader population that uses cash for reasons of privacy rather than financial exclusion, it represents the progressive disappearance of an option that once existed. The FDIC survey also identified that 2 million American households are underbanked, possessing bank accounts but relying significantly on cash and non-bank financial services for daily transactions. These households skew toward lower incomes, rural geographies, and communities that have historical reasons for skepticism about financial institution oversight. The digital dollar's proponents argue that CBDC inclusion mechanisms can serve these populations better than cash. The digital dollar's critics argue that serving these populations through programmable, government-issued digital currency is not inclusion. It is surveillance of the populations least equipped to advocate for their privacy interests. Chapter 4, the programmability question. Here is the mechanism that makes financial analysts and civil liberties researchers simultaneously most interested and most concerned. A programmable digital currency is not merely a record of transactions. It is a currency that can carry instructions, conditions that govern where it can be spent, when it expires, whether it can be saved, or must be spent within a defined time frame. These capabilities exist in the technical architecture of CBDC systems and have been deployed in limited ways in Chinese pilot programs. The digital yuan's COVID-era distribution included time-limited tokens designed to stimulate consumption by expiring, if not spent, within a defined window. This is a capability that no form of physical cash possesses. And that no prior form of American money has possessed. The policy applications of programmable money extend in directions that are individually plausible and collectively transformative. Targeted stimulus payments that can only be spent at American manufacturers, enforcing Buy American provisions through currency programming rather than regulatory compliance. Healthcare savings accounts that can only be spent at licensed medical providers, with the Federal Reserve's infrastructure validating the license status in real time. Carbon usage allocations that limit transactions in sectors generating above-threshold emissions, implementing environmental policy through payment infrastructure rather than through legislation. Each of these applications has genuine policy logic. Targeted stimulus that supports domestic manufacturing is more economically effective than broadly distributed stimulus that is spent on imports. Healthcare spending accounts that prevent misuse protect program integrity. Environmental policy implemented through payment infrastructure is less susceptible to regulatory avoidance than rules-based frameworks. The question that the policy logic does not address is the governance question. Who decides which transactions are authorized, which are conditional, and which are prohibited? Under what legislative authority are those decisions made? With what judicial oversight are they applied? And how does a citizen contest a payment restriction that the programmable currency system has imposed without human review? These are not hypothetical questions. They are the questions that every nation that has deployed programmable currency elements, China, Nigeria, the Bahamas, Jamaica, has resolved through executive authority rather than through the legislative and judicial frameworks that American constitutional tradition applies to government interference with financial activity. Chapter 5. The Architecture of the Decision Point. America is at a decision point about the digital dollar that is more consequential than most of its participants appear to recognize. The Federal Reserve's exploration of CBDC is technically sophisticated and institutionally serious. Project Hamilton, the collaboration between the Boston Federal Reserve and MIT's Digital Currency Initiative, produced technically rigorous analyses of CBDC implementation options. The Federal Reserve Board's January 2022 discussion paper laid out design considerations with intellectual honesty about the trade-offs involved. Federal Reserve Chair Powell has consistently stated that any CBDC implementation would require explicit congressional authorization. The congressional authorization requirement is the critical governance point. The Federal Reserve's technical exploration is not a committed deployment decision. Whether a digital dollar is implemented and what privacy protections it carries depends on legislative choices that Congress has not yet made. The legislative window, the period during which the design decisions that determine the privacy architecture of the digital dollar will be made, is the 2025 to 2027 timeframe, in which both geopolitical pressure from Chinese CBDC expansion and Federal Reserve technical readiness will create the political conditions for definitive congressional action. For the professional audience that analyzes this question seriously, the finance professionals, technology executives, international economists, and policy analysts who are the core audience for this analysis, the digital dollar question is not resolved by a binary position. It requires understanding the following distinct questions simultaneously. Is some form of American CBDC necessary to maintain dollar hegemony against Chinese digital currency expansion? Probably yes, given the Enbridge trajectory. Can that CBDC be designed with privacy protections meaningfully stronger than the commercial banking standard? Technically, yes, through design choices that limit transaction visibility to defined legal process requirements. Will political and law enforcement pressure push the architecture toward maximum transaction visibility? The historical pattern of financial surveillance system design suggests yes, in the absence of explicit legislative constraints. The European Central Bank's digital euro design process is instructive. The ECB has committed to privacy protections that include offline payment capability, simulating the anonymity of cash for low-value transactions, and explicit restrictions on ECB access to individual transaction data. Whether these commitments survive implementation is uncertain, but their explicit inclusion in the design framework reflects a political environment where citizens demanded privacy protection as a condition of CBDC acceptance. American CBDC design will reflect American political priorities. Those priorities are shaped by the public debate that precedes legislative action. The 2027 decision point is approaching. The architecture that will be locked in at that point will determine for a generation the relationship between American citizens and the money that represents their economic agency. What happens to cash? Cash does not disappear in 2027, but the decision made in 2027 will determine whether cash's successor, whatever form American digital money takes, preserves the financial privacy that cash has always provided or eliminates it in the interest of policy effectiveness, payment efficiency, or geopolitical competitiveness with a Chinese system that was never designed with privacy as a priority. That decision has not been made. The window in which it will be made is open, and the mechanism by which it will be made, congressional legislation, Federal Reserve design choices, and the political pressure that shapes both, is operating right now mostly outside public view, in exactly the ways that decisions of this magnitude typically are. Understanding the mechanism is the first requirement for influencing the outcome. The 2027 clock is running,